Welcome to The Explainer. Today, we're diving into a huge shift happening right under everyone's noses. It's a quiet consensus that's forming inside the Federal Reserve, and believe me, it signals the end of a whole era for investors. All right, let's just jump right in with this quote because it perfectly nails what's going on. We're looking at this massive gap, a disconnect between what the market wants to happen and what the data is screaming at us. It's like everyone is reading from an old script, and the world has already moved on to the next act.
So to really get what's happening now, we first have to rewind and look at the story investors have been holding on to for the entire year. It's a story of hope, for sure, but it's a story that's starting to look really, really fragile.
For months, the main story was just so simple, so appealing. The economy's cooling down, inflation's finally getting back in its box, and pretty soon the Fed's gonna pivot and start cutting interest rates. You could practically feel the excitement in the air. I mean, it was priced into everything, stocks, bonds, you name it.
And, this wasn't just blind faith. It was actually based on what looked like pretty solid data coming out of late 2025. The job market was softening a bit, inflation numbers were heading in the right direction, and even Fed officials were hinting they were open to easing up. The market took that and ran with it, pricing in multiple rate cuts like it was a done deal. That was the only story in town.
But then, a geopolitical crisis just completely shredded that old script. A classic economic plot twist showed up, not from some spreadsheet in DC, but from a conflict thousands of miles away.
The global economy has just been slammed by something called a supply shock. Now, what is that? It's basically an outside event that messes up the supply of something essential, which causes shortages and sends prices soaring. The textbook case is the 1973 oil crisis, and unfortunately, we're seeing a pretty scary echo of that right now.
So, after months of tensions building up, a joint U.S.-Israeli military operation targeting Iran has escalated, and the result is the closure of the Strait of Hormuz. Now, this isn't just some regional issue. This is a major choke point for the entire global economy. As Citadel's Ken Griffin warned, if that strait stays closed for long, it could single-handedly push the world into a recession.
And the immediate fallout? Well, it was obvious. The price of Brent crude oil shot up to almost $126 a barrel. This is not a small jump. This is a massive new inflationary force being pumped directly into the veins of the global economy. It affects everything, from the price you pay at the pump to the cost of making and shipping literally everything you buy.
Okay, so this new threat of inflation is forcing a quiet but totally dramatic change of heart inside the Federal Reserve. A brand new consensus is taking shape, and it looks nothing like the market's hopeful little script.
First things first, the Fed has totally abandoned its average inflation targeting policy. Remember that? It was their post-pandemic plan to let inflation run a little hot to make up for years when it was too low. Well, in today's world, that policy looks like playing with fire. So they've gone back to a super strict, no-nonsense 2% target. This isn't just a little adjustment. It's a huge change in their whole philosophy.
And this isn't just about abstract policies. You can hear it in the way Fed members are talking. In late 2025, the vibe was dovish, pointing toward rate cuts. Now, even well-known doves like Governor Miron are walking back their predictions, saying publicly that fewer cuts are coming. The doves have either gone silent or they've turned into hawks.
And we can see this change in black and white right in the Fed's own forecasts, the famous dot plot. The median guess for interest rates at the end of 2026 has been revised way up. But here's the real kicker. Look at the change in the long-term rate. It's up from 2.5% to 3.0%. That's the Fed signaling that they think the whole interest rate structure just needs to be permanently higher. The old story of easing is coming is dead. The new story is higher for longer.
So why the big change of heart? Well, as Chair Powell has basically said, after fighting high inflation for 5 straight years, the Fed's reputation is on the line. They just can't afford to ignore an energy shock like this one. The biggest fear is that if they do nothing, people will just start to expect high inflation forever. That's called de-anchoring, and it's a central banker's worst nightmare.
So, if the market is stuck on an old script and the Fed is busy writing a completely new one, let's just look at the hard data. Let's dig into what the numbers are telling us right at this very moment.
In a world with so many conflicting stories, where you hear one thing from Wall Street and another from Washington, where do you actually find the truth? Which indicator is telling the most honest story right now?
It's hiding right here, in the 10-year Treasury yield. It has blown past 4.3%. And that number,
That number reflects a completely different economic world than the one the rate cut optimists are dreaming about.
Don't just think of this as a number on a chart. Think of it as the Fed's unification chart. It's the picture of the bond market, the so-called smart money, slowly, painfully giving up the ghost on rate cuts and finally accepting the Fed's new, unified, hawkish reality. Every single tick up on that chart is another investor waving the white flag and admitting the data has won.
And the way the yields are rising is super important. We're in what's called a bear steepener. I know, it's a technical term, but what it means is simple. Long-term rates are rising faster than short-term ones. That happens when the market is freaking out about future inflation, not when it's expecting the Fed to come riding to the rescue with rate cuts. It's the exact opposite signal.
And it's not just the bond market. Look at the actual inflation data. The 10-year break-even rate, which is basically the market's inflation forecast for the next decade, is stuck at 2.4%, way above the Fed's target. Producer prices are picking up steam, and the latest CPI number came in hot at 3.3%. Every single one of these data points backs up the Fed's tough new stance.
So all of this boils down to one critical question that every single investor has to ask themselves. Are you going to keep clinging to that old, hopeful script, or are you going to pay attention to the new one that the data is writing? Are you really willing to fight the Fed and the bond market at the same time?
Look, at the end of the day, the brutal truth is that hope is not an investment strategy. Right now, the bond yields, the inflation numbers, and the Fed's own quiet consensus are all telling a very clear story. The data has a hawkish bias. And the real question is, how long will it take for the rest of the market to finally accept a script it just doesn't want to read?